In February 2006, something invisible happened in the bond market. No headlines, no panic, just a quiet, mathematical flip that would later mark the exact starting gun of the worst financial crisis in 80 years. The yield curve inverted. And if you don't know what that means, you're not alone. Most people have never heard of it. But here's the uncomfortable part. It's predicted every single recession for the past 50 years. Everyone, with only one false alarm. I used to think economic predictions were astrology for people with spreadsheets. Then I spent 2 weeks going down the rabbit hole of treasury bonds, Federal Reserve data, and yield curve mechanics. And what I found wasn't magic, it was math. Cold, structural, and disturbingly accurate. So if you've ever wondered why economists obsess over something as boring as government bonds, or why a recession always seems to sneak up on us even though the warning signs were flashing months earlier, this is the system you need to understand, because the next time it inverts, the clock starts ticking. Let me show you how it works. First, forget everything you think bonds are. They're not complicated. A bond is just a loan. You lend the government money. They promise to pay you back with interest. The interest rate they offer is called the yield. The time until they pay you back is called maturity. The U.S. government issues bonds at different time lengths: 3 months, 2 years, 10 years, 30 years. And normally, the longer you lend the money, the higher the interest rate they pay you. That makes sense, right? If I ask to borrow $100 for a week, you'd probably say yes. If I ask for 10 years, you'd want more compensation, more risk, more reward. That relationship between time and yield creates a curve, literally. When you plot short-term rates on one side and long-term rates on the other, it slopes upward. That's a normal yield curve. It's what happens when the economy is functioning the way it's supposed to. People trust the future. Lenders feel confident. Everything's fine. But sometimes that curve flips. Short-term rates go higher than long-term rates. The graph inverts. And when that happens, it's not just some technical glitch in the bond market. It's a signal, a warning, a mathematical scream that something is broken in the machine. Here's why. When investors expect the economy to weaken, they start buying long-term bonds as a safe place to park money. More demand for long-term bonds drives their yields down. At the same time, the Federal Reserve usually raises short-term interest rates to fight inflation or cool down an overheating economy. So short-term yields go up, long-term yields go down. The curve inverts. And that inversion is not a coincidence. It's a reflection of belief. The bond market is telling you, we think the economy is about to hit a wall. We think growth is going to stop. We think a recession is coming, and we're willing to bet billions of dollars on it. Now, you might be thinking, okay, but markets are wrong all the time. People panic, people overreact. Why should we trust this one indicator? Fair question. Let me give you the track record. Since 1970, the yield curve has inverted 7 times. 7. And in every single case, a recession followed. 1973, 1980, 1981, 1990, 2001, 2008, and 2020. The only time it gave a false signal was in the mid-90s, when it briefly inverted, but no recession came. One miss in 50 years. That's a better success rate than almost any economic model we have. Better than unemployment data, better than consumer confidence surveys, better than GDP forecasts. But here's where it gets stranger. The inversion doesn't cause the recession. It predicts it, sometimes 6 months in advance, sometimes 18 months. The gap varies, but the pattern holds. And that delay is part of what makes it so unsettling. Because by the time people start losing jobs and companies start closing, the bond market already knew. Let me walk you through 2006 again. The yield curve inverted in February. The stock market was still climbing. Unemployment was low. Housing prices were booming. Everything looked fine. But beneath the surface, the bond market was screaming. 18 months later, in late 2007, the recession officially began. By 2008, the entire financial system was on fire. Or look at 2019. The curve inverted in August. The media talked about it for a week, then moved on. Life continued. Then COVID hit in early 2020, and we entered the sharpest recession in modern history. Now, obviously, COVID was an external shock, but the bond market was already sensing weakness before the pandemic even started.
So what's actually happening under the hood? Why does this relationship exist? The answer is about how banks work. And this is the part most people miss. Banks make money by borrowing short and lending long. They take your deposits, which are short-term obligations, and they use that money to make long-term loans, like mortgages and business loans. When the yield curve is normal, this works beautifully. They borrow at low short-term rates and lend at higher long-term rates. The difference is profit. But when the curve inverts, that model breaks. They're borrowing at high short-term rates and lending at lower long-term rates. They lose money on every transaction. So what do? They stop lending. They tighten credit. And when banks stop lending, businesses can't expand. Consumers can't borrow. Growth slows. Hiring freezes. And eventually, the economy tips into recession. The yield curve doesn't just predict a recession, it helps create the conditions for it. Now here's the uncomfortable part. In July 2022, the yield curve inverted again. The 2-year Treasury yield went higher than the 10-year. It stayed inverted for months, longer than any inversion since the 1980s. And the entire time, economists were on TV debating whether this time was different, whether the old rules still applied, whether we'd finally broken the pattern. Some said the model was outdated, that quantitative easing and Federal Reserve intervention had distorted the bond market so much that the yield curve no longer meant what it used to. Others said inflation was the real problem, not growth, so an inversion didn't carry the same recessionary signal. And for a while, it looked like they might be right. The job market stayed strong, consumer spending held up, GDP growth was positive. People started calling it a soft landing. The Fed would tame inflation without triggering a recession. The yield curve had finally cried wolf. But then cracks started showing. Regional banks failed. Credit tightened. Layoffs began in tech and finance. Economic growth slowed. And even if we avoid an official recession, which requires 2 consecutive quarters of negative GDP growth, the economy clearly shifted. Hiring froze. Raises disappeared. The vibe changed. And the bond market saw it coming 18 months earlier. So why don't we just listen to it? Why don't policymakers and businesses adjust their behavior the moment the curve inverts? Because no one wants to be the person who caused a recession by preparing for one. If a CEO starts laying people off because the yield curve inverted, and then no recession happens, they look incompetent. If the Federal Reserve cuts rates preemptively, they risk letting inflation spiral. There's this paradox where the signal is reliable, but acting on it is politically and economically dangerous. So instead, everyone watches, everyone knows, and everyone hopes this time will be different. It never is. The other reason people ignore it is because it's boring. An inverted yield curve doesn't make for good television. There's no fire, no explosion, just a line on a graph crossing another line. It doesn't feel urgent. And our brains are terrible at responding to slow-moving threats. We're wired for immediacy,
for visible danger. A bond market signal doesn't trigger that response. But that's exactly what makes it powerful. It's not emotional, it's not speculative. It's just the collective judgment of millions of investors with billions of dollars on the line, all betting on what the future holds. And historically, they've been right. Now, does that mean the yield curve will always work? Probably not. At some point, the structure of the economy or the bond market will change enough that the relationship breaks down. Maybe central bank interventions really have distorted things beyond recognition. Maybe new financial instruments or global capital flows have shifted the rules. Maybe the next inversion will be the first real false alarm. But betting against a 50-year track record is a dangerous game. And here's what makes this whole thing so uncomfortable. The yield curve doesn't care about optimism. It doesn't care about innovation or resilience or any of the narratives we tell ourselves about the economy. It just reflects cold math, supply and demand, risk and reward, time and expectation. When it inverts, it's not making a moral judgment. It's not rooting for failure. It's just telling you what the data says. And every time we've ignored it or convinced ourselves the rules had changed, reality eventually caught up. So the next time you hear that the yield curve has inverted, pay attention. Not because it means the world is ending, but because it means the timer has started. Somewhere between 6 and 18 months from that moment, the economy will likely shift. Jobs will disappear, growth will stall, and all the people who said it was different this time will quietly stop talking about it. The bond market doesn't lie. It just speaks a language most people never learned. And maybe that's the point. The warning is always there. We just choose not to listen until it's too late. So the question is, if the curve inverts tomorrow morning, what would you do differently?